the 10th of January 2025, yeah? Okay, news events. Today I'll talk about the report on Federal Reserve minutes and market implications. Now, why do I want to look into this one? Because this is more detailed, and the expectations all written on paper. And then it's also good to dwell in it to have an idea to see, what's the future direction and are there any hints left by the Feds in the minutes, okay? So insights first from the Federal Reserve minutes. The minutes from the Federal Reserve December 17 to 18, 2024 meeting reveal a cautious approach to monetary policy. Now, the Fed trimmed its interest rate range by a quarter percentage point to between 4.25% and 4.5%, signaling a slow pace of future rate cuts. Now, these adjustments reflects ongoing concerns about persistent inflation and the resilience of the US economy. So, the Federal Reserve's rate cut projections for 2025, first of all, is this. Now, the Fed, right, projects potentially 2 rate cuts in 2025, totaling 0.5%, which aligns with the bond market expectations that also foresee a less aggressive approach to rate cuts. Okay, this is something crucial that we need to know because this comes from the Fed minutes. It's not outside there, the speculation. I've seen some speculating up to 0.75%. At the current moment, though that may come true in this year, but whatever it is, we have to look at this, whatever is written in the minutes. First of all, I think that is crucial and important. Now, the current bond market forecast as per CME Fed Watch 2 suggests a high probability of maintaining the current rate range into the first half of the year, with gradual reductions expected late in the year, reflecting a cautious monetary easing trajectory. Okay. Number 3, and I think this is also quite important, the plan on quantitative tightening. Now, according to recent updates, Wall Street banks anticipate that the Fed quantitative tightening efforts, which aim to reduce the Fed's balance sheet from a peak of 9 trillion to just under 7 trillion, will conclude around June 2025. Okay, so this is when they stop tightening. So this is a crucial thing you should know. Okay, this timeline is an adjustment from previous expectations, which saw the process ending a month earlier. Okay, so they've adjusted that. Now, the goal of QT has been to normalize liquidity levels in money markets and ensure the central bank's effective control of its primary economic influencing to the federal fund rate. Okay. Now, next, the expectations for the US stock market and the US dollar. Now, the slowing pace of rate cuts and the continuation of quantitative tightening are likely to have mixed implications for the US stock market and the dollar. For the US stock market, the cautious approach to lowering rates and ongoing QT may lead to reduced liquidity, which could dampen markets' exuberance. However, a controlled economic environment with gradual policy changes might also provide stability, potentially supporting market confidence. For the US dollar, a less aggressive rate cut strategy and a strong focus on controlling inflation are typically bullish for the dollar. As the Fed maintains higher rates relative to other major economies, the dollar may continue to attract investment strengthening in the forex markets. So as a conclusion, this conclusion stems from a scenario where the Fed, as well as investors, are uncertain about the potential impacts of President Donald Trump's anticipated trade sanctions on the US stock market. So the impact on the US stock market, we don't know yet. We have some educated guess, but we don't know. Because why? Investors typically shy away from uncertainty, and it is anticipated that the first quarter might serve as a period of observation, potentially leading to weaker stock market and a stronger US dollar. So from right now, right until the first quarter, okay, so probably ending about March, mid-March, April, that kind of thing, we might see a period observation, that is sideways movement, or probably the US stock market coming down instead. So as the year progressed, the stock market is expected to potentially recover by mid-March into April Q2, early April Q2. So this is where I expect it to go up, because it can be like the current situation, inflation is high, then we have the trade war going on, and we don't know to what extent how this trade sanction, war, how Trump is going to bring it. But if the market thinks, actually it's not that bad and okay, we might be able to see a recovery coming mid-March into early April or mid-April. Okay, so this recovery is predicted on the assumption that the Fed will gain a clearer understanding of the market dynamics after accumulating more relevant data, because from now to March, we're going to go through many data of inflation and so on, and the what do you call the jobs data as well. So that will enable more informed interventions happening. Okay, so if you can see, if they're going to end QT by June, right, there is the market could be in a celebrity mode, because celebrating said like, okay, there's liquidity is not going to be cut already, then it's almost done now, and what's next is to slowly bring the rates down. As you bring the rates down further and further, it comes to a point where it said, okay, we are back at a level where probably the printing machine can start all over again. Now this kind of news can actually bring the market up all over again. Okay, so I still see overall, based on the jobs data that we have received so far right up to date, the US stock market, I would consider economy is still resilient. I'm not saying that it's good, but it's still resilient. It still can withstand whatever it's facing right now. Okay, so with that, it could still continue chug along until at least June. Then we will see from there. Okay, so with that, that's the report for today.